Hello everyone, welcome to Bald Guy Money, and 3 weeks ago on September 7th, I came on here to warn you all that a major shift in the financial world was coming and that what we know as the 60-40 portfolio, which was invented in the 1950s and favors a 60% investor allocation to stocks and 40% allocation to bonds, was coming to an end, and that it would trigger a flood of money into precious metals, sending gold and silver prices to incredible new highs. Now, it was only 10 days after I published that video that this article showed up in the news, and some of you may have heard about it already, but what it says is that the chief investment officer at Morgan Stanley, the sixth largest bank in the United States and one of the largest banks in the world, is now saying almost exactly what I said on September 7th. In fact, he's taking it even further by suggesting that instead of allocating 60% to stocks and 40% to bonds, he thinks it's better to allocate 60% to stocks, 20% to bonds, and 20% to gold, which is more than double the 8% gold allocation I suggested was coming. And his reasoning for this was, and these are his words, gold is now the anti-fragile asset to own rather than treasuries. High-quality equities and gold are the best hedges, meaning that he saw exactly what I saw in the early months of this year, where gold, despite a crashing S&P 500, went up, and it means that a lot of things you thought you knew about how gold behaves, especially in a crash, are probably no longer valid because gold is replacing the US dollar and US treasuries and bonds as the safe haven, which means there will be no major crash in metals prices, and at best, you'll get a modest pullback from possibly much higher prices, which you may or may not be able to buy. Now, in this video, I want to show you all in simple terms exactly what I'm talking about here, starting by showing you all exactly how early we are in this gold and silver bull market, and I will give you an exact year as a reference. Once that's covered, I will reveal what kind of gains gold and silver are going to experience moving forward from here, and honestly answer the question of whether the biggest gains are in front of us or already behind us. And we'll finish this video off with a discussion on why owning the right gold and silver matters in 2025. And this will be a major wake-up call for many longtime stackers who still think we're living in the 1990s and early 2000s. I will talk about what's changed and what you need to do to keep up with those changes. Now, just before we dive in, please remember to check out summitmetals.com if you want to buy gold and silver at a great price from a dealer you can trust while also supporting my channel at the same time. And if you want to get on a buying schedule now, which is something I encourage, check out their auto invest option that makes dollar cost averaging as easy as clicking your mouse. So, jumping in, it's not only Morgan Stanley that is signaling a shift to gold, and if anything, they're followers in this situation, because BlackRock, the world's largest money manager with $11.5 trillion in assets under management, making them approximately 10 times larger than Morgan Stanley, has already talked about this shift to gold. And it happened at the end of August of this year, and I seem to be the only person talking about it, at least as far as I've seen, but it's more significant than people realize. Now, just as a reminder to everyone as to what BlackRock said in their fall investment report, they said investors should consider gold as an alternative to challenges appearing in the market when it comes to stocks and bonds, while issuing an additional warning on bonds, suggesting that a combination of lower interest rates and steady inflation could result in interest rates earned on cash savings to turn negative and to seek sources of income elsewhere, like dividend stocks, which is also likely supporting performance of the mining stocks. Now, the reason this is so important and why people need to pay attention to what BlackRock says all comes back to something I shared on my weekly Patreon conference call a few weeks ago, and I want to share that message with you all here on the YouTube channel, because the message was BlackRock doesn't lose. They are a leader and others follow what they do. And a great example of that, love it or hate it, is how BlackRock started advising their clients to gain exposure to Bitcoin in early January 2024, coinciding with the launch of their Bitcoin ETF. And as you've probably noticed in the image here on the screen, BlackRock started buying Bitcoin to seed their ETF at $42,300. And since that initial purchase, the price of Bitcoin has nearly tripled. So this is why I say BlackRock doesn't lose and that the market moves with them, suggesting we are only in the early days of this gold and silver bull market. Now, in addition to BlackRock and Morgan Stanley getting on board with gold, we are also seeing weakness in the US dollar. And that weakness is going to get a lot worse, as I said back in July of this year, as interest rates come down and de-dollarization progresses, causing the dollar to break below 97 on this index that measures the strength of the US dollar versus other currencies, triggering, much in the same way that it did back in 2003, a long-term, possibly permanent bear market for the US dollar as its role in the financial system slowly changes and evolves. So considering those signals, starting with major institutional moves towards precious metals, like we saw in 2004 and 2006 when the first gold and silver ETFs were launched in the United States, combined with a weakening dollar, I'd say where we are today versus the bull market of the early 2000s is that we're somewhere between 2003 and 2006, where despite major run-ups in gold and silver prices of 110% for gold and 219% for silver from January 2003 to the 2006 highs, both metals made their biggest moves up in the 5 years that followed that period, going out to 2011. The only thing that's different this time around is the fact that institutions are getting ahead of the dollar breakdown instead of reacting after the fact, and that includes the central banks, who were really the first ones to the party. And switching over to a silver chart, for those of you worried about your silver positions or questioning if you should still be buying it as we approach $50 for silver for only the third time in history, I want you all to see what you'll be missing out on if you quit now. Because even though I think we may get a little resistance and possibly a small pullback at $50 an ounce, in the greater scheme of things, if I end up being right about where we are in the current metals bull cycle, and I'll let you judge my track record so far here on YouTube for yourselves, it means $50 silver is nothing. And quitting now would mean forfeiting or giving up what I think are going to be the largest moves for silver, probably since it was first adopted as money 5,000 years ago. And that message applies to gold too. Now, just before we continue to the topic of why people need to wake up to a new reality on gold and silver products, please remember to visit channel partner landofland.com to find out how to add some land to your portfolio, both easily and affordably. That includes large pieces of land like this 17.4 acre property, perfect for preppers, located in northern Maine, selling at a reduced rate for my viewers at just under $30,000. But no matter what it is you're looking for, they have a piece of property that fits your needs. So if you've wanted to add land to your portfolio, check out landofland.com or call the number on the screen and use code BALDGUY to get $300 off your purchase. Many of my viewers already have, and the feedback I've received has been extremely positive. So with that covered, it's time to answer this video's viewer question. And please remember, I answer one viewer question in every video I do. All you have to do is submit your question in the comments section below, and you never know, it may appear in my next YouTube video. And this one comes from Glenn Gale, and he asked what my opinion is on buying ETFs. So I am going to use this as an opportunity to let you all know what I think people should be buying, with some additional information for experienced gold and silver stackers to consider who may not be buying right now, but also may not have their stack correctly positioned for what I think is coming. So we start this off with a little classification of investors because depending on where you fall in this classification, you probably buy gold and silver differently because on one side, you have people who invest based on fear. And these are people who are usually suspicious of the status quo, and their goal is to get enough wealth safely out of the paper financial system to protect them from whatever event it is they're afraid of. Now, on the opposite side, you have greed investors, people who follow the latest trends and are trying to make a capital gain in fiat currency by riding the trend. So to get the greed investor out of the way, if that's you, buying the ETFs is perfectly fine, assuming you won't be in them for very long. You save the hassle of paying a premium on your metals, and you can sell them at the click of a button when you're ready to take your profits in US dollars, most likely. But for fear investors, the very understanding of how these ETFs work is enough to persuade them to buy and own physical gold and silver, because instead of using your money to buy the metal and store it in your name, most ETFs take your money, they charge you a fee, they buy the gold and silver, and then lend it out to other people at varying levels of risk to earn extra profit on it. And although that doesn't sound all that risky today, I can tell you that it is risky. Because it's this practice that had the European Central Bank sounding the alarm on the gold market a few months ago, saying that even minor destabilizations in the financial system could cause chaos in the market as investors, traders, and speculators scramble to buy a limited amount of physical gold to cover bets they've made with larger amounts of paper gold. And although I won't get into the details of what it is they said exactly, it tells us that when you own an ETF, you don't own any metals. What you own is a claim to the price in a failing currency. And that claim that you have can theoretically be settled at any time the ETF manager wants, even in the event of a currency collapse, which means in an extreme case, you can have your position settled and paid back to you in worthless paper. And this is what the fear investors, including myself, understand. And it's written clearly in basically all gold ETF investment documents where they say, and this is real, this is not me trying to stir up fear in the community, but this is what it says, that upon liquidation of the ETF, assets, so in this case we're talking about gold or silver, are sold off and the proceeds are distributed proportionally to shareholders in the fund's base currency, which is usually US dollars. Now, I know some of you watching this are probably yelling at the screen right now, but PHYS and PSLV, which are the Sprott Physical Metals ETFs, those are ETFs where the owner has a claim to the real metals and can redeem shares in exchange for physical metals. And that's true, but only for some people. And if you think that applies to you, think again, because unless you own the equivalent of 400 ounces of gold in the PHYS physical gold ETF or 10,000 ounces of silver in the PSLV physical silver ETF, you have no claim to the physical metal at all, even today. And considering the fact that we're talking about $1.5 million and $460,000 in value respectively, I assume that most of you who are holding that ETF have no real claim to the physical metals at all, meaning it's really no different than owning the GLD or SLV ETFs, and I'm sorry to have to be the bearer of bad news on that. But that's why owning physical metals, from my point of view, is the safest option, assuming, of course, that you can safely store it. And although I'm not going to get into the details of safe storage in this video, once you've made the decision to own physical metals, what to own becomes almost as important as the decision to own those physical metals in the first place. And for years, when it comes to gold, the conventional wisdom has been buy 1 ounce coins because they come with a lower premium compared to smaller fractional gold pieces, and they are the easiest to sell or trade because they are in high demand. In fact, they are in the highest demand. But with gold affordability dropping like a stone in the water what was once the pillar of a middle class or even upper middle class stacker's gold position, the 1 ounce gold coin, is now unaffordable to the typical American and probably most people living outside of the United States. And I'm not trying to be, once again, a fearmonger when I say this, but considering where the price of gold is going, we may, one day in the future, look at owning a full ounce of gold in coin form like we look at owning a kilogram bar of gold today. And in the case of silver, which is suffering the same fate as gold as it falls in affordability, a 100-ounce bar, which many experienced stackers own, is now out of reach for most regular Americans, just like the 1 ounce gold coin based on a full year of their savings, with a typical American at current spot price only being able to afford about 77 ounces of silver with an entire year's savings. So although I still support owning 1 ounce gold coins and a few bars in the silver stack, I think people really need to start preparing not only for more inflation and potentially a debt-based currency crisis, which is why we stack gold and silver in the first place, but they should also prepare for a reality where smaller denominations of gold and silver become the norm, not only as metals prices go up, but as the real value of those metals goes up with them. Because people who say it's not the value of gold and silver that goes up, it's the value of our currency that goes down, well, those people are just simply wrong. Because as technology improves our ability to produce things cheaply, the cost of goods, thanks to the improved productivity, should be going down. Prices should not be going up. And although you don't see that when measuring in US dollars or euros or Japanese yen, you see it clearly when measuring in gold and silver. And although this applies to many things, in fact, I'd probably say it applies to most things, the example I want to use here is the iPhone, as the latest one was released last week at $799, which is an increase versus the first $499 iPhone of 60%. But when measured in gold and silver, where the first iPhone cost nearly 1 ounce of gold and 40 ounces of silver, the latest one costs about 1/4 ounce of gold and 17 ounces of silver, which is a 72% decrease when measured in gold and a 57% decrease when measured in silver. And it shows you at this early stage of the precious metals bull market just how far our metals will go in the future. And that's precisely why I encourage everyone to stack, at least in part, some smaller denominations of gold and silver like what you're looking at on the screen here. And I'd start with 1/4 ounce gold coins and American junk silver, not because I have an ulterior motive to sell you something, but because what I've been warning about since I first brought this topic up in 2023, which is the falling affordability of metals, has been coming true. Yet I still see people in the comments section of my videos discouraging budget stackers from buying what they can afford today while encouraging them to save up for example, the full ounce of gold. And all I have to say to that is, if you had bought 1/4 ounce of gold on a schedule of 1 coin every 3 months over the last 2 years, you would not have only saved money on the purchase, despite the higher premium on the fractional gold piece, but it would also have delivered you greater flexibility in your precious metals stack, allowing you to sell off smaller amounts of gold and silver without having to sell, for example, full ounces or large 100-ounce silver bars in case you have a small emergency expense to cover. So with that said, that's my message for this video, and if you enjoyed it, please remember to leave a like below, and if you have any questions for me that you'd like to see me cover in future videos, please leave them in the comments section below. If I get enough comments, I will do a bonus video this coming Tuesday, so please keep that in mind. If you were not planning on leaving a comment, if you do and you want an extra video, well, that comment may deliver an extra video later on this week. And one more thing before we sign off, I just want to say, if you think this content is valuable and that there are people in your life who need to hear this message, please don't be shy. Share it with them as it helps my channel grow. And as I say at the end of all my videos, please, please, please remember to take care of yourselves and take care of each other. Have a great week ahead. See you in the next video. Goodbye.